Okay, so part two is the antebellum central banks, the Bank of the United States and the Second Bank of the United States. Everyone in the room know who this is? Okay, I hear a few chuckles. He's kind of like the villain, right? At least in the eyes of some people. Okay, so that's Alexander Hamilton, and that's his first Bank of the United States, which, by the way, is still there. I didn't even have to find a painting. The building still exists, and it's a historic monument. Okay, I couldn't find a photograph, present-day photograph, without protesters surrounding the building. Okay, all right. But I won't go into it in detail. A lot of people in this group are probably familiar with the famous debate between Hamilton and Jefferson, whether we should have a first central bank or not. And Hamilton won out and got a 20-year charter from 1791 to 1811. And the first Bank of the United States was a destabilizing, as was the second, destabilizing factor in American history. Now, there are, again, Fed apologists who will say, well, you can't blame the first Bank of the United States. It didn't have the kind of powers. And this is true, by the way. It didn't have nearly the broad powers that the Federal Reserve has. It didn't have a monopoly on banknote issuance. It didn't have a monopoly on creating reserves. It wasn't. It was dependent on gold or silver as a reserve back in those days. It couldn't control interbank lending interest rates. It couldn't convince the White House and Congress to pass TARP and buy $700 billion in equity stakes in banks. But the powers that it did receive were great enough. They were still significant for it to have an enormous negative influence on the U.S. banking system. So the first is, I'm not sure if you all were aware of this, the U.S. government was a 20% owner of the Bank of the United States itself. So now, again, you have the government's interests aligned with the banks. I guess we would call that crony capitalism in this day and age. And just like the state banks, the federal government didn't have the money. It had to take out a loan from the first Bank of the United States to buy the 20% stake, and then it paid off the loan with the dividends. And here's the key. The Bank of the United States, this should sound familiar, kind of like the Bank of England, is granted the monopoly on interstate branching. So no other bank in the U.S. is allowed to branch outside of a certain region or outside the state or even beyond its own unit bank, but the Bank of the United States has the sole privilege of going wherever it wants, and it quickly did. It quickly branched all over the U.S. Its banknotes are accepted, no questions asked for tax payments, which ensures that the banknotes will continue to circulate. Although it really didn't even need that privilege for its banks to circulate, simply the prestige was enough. Since the government deposited all its funds with the Bank of the United States, that gave it a certain magnanimous quality where the public perceived it as a very safe bank. Too big to fail, I wrote, because after all, the federal government's not going to let its own bank of deposit fail and take its deposits with it, right? So as a result, the banknotes circulated very freely within the United States. But because of that, the Bank of the United States' own credit policy would have a huge influence. It's like this. It's almost like a central bank. It's this one bank. If it decides to inflate credit or contract credit, it's going to have a disproportionate effect on the overall economy than these single unit banks that are scattered all over the states. And that's exactly what it did. Okay, so when it opened its doors in 1791, it immediately began expanding credit. And I'm going to have some charts I can show you to prove this. And there were two private bankers with all the easy money floating around, decided to start speculating. They were trying to corner, I forgot what market it was. I'll have to look it up. There's a paper I found that explained it. They tried to corner like a certain bond market or something, and it failed. And when it did, their own banks became distressed, and they began to contract credit. And this led to the Panic of 1792, which, by the way, was a very small panic. It wasn't one of the big ones. And Alexander Hamilton, he was Secretary of the Treasury, but he was unofficially running the first Bank of the United States. He immediately acted and loaned generously to Duer and Macomb, these two troubled bankers. And he's often cited, for better or for worse, as having anticipated the whole lender of last resort concept. 80 years before Walter Bagehot, I don't know if you're familiar with Walter Bagehot, first wrote about how the Bank of England should lend to distressed banks during times of crisis. So he loaned generously to these two banks, and it did result in a sense of normalcy, and the credit markets kind of calmed down. But there was this brief panic in 1792. Now, that being said, Hamilton should have learned his lesson from that experience, but he didn't. In late 1792, he went right back to lending generously and expanding credit. And this lasted a lot longer than 1 year, by the way. And he did it in part, by the way, to keep U.S. bond prices up, because he wanted cheap credit for the federal government. So just like today, you know, we've had, 8 years of zero interest rates, and only in the last 2 years have interest rates have started to creep up. This has been very beneficial to the federal government, hasn't it? Okay, all that money is pushed up. Stock prices, bond prices, housing prices, and when bond prices go up, the effective interest rate that the federal government pays goes down. And you could almost call this a form of QE back in those days. Hamilton also cited stimulating business activity, so he was somewhat of a pre-Keynesian as well. And did he ever stimulate business activity? Okay, inflation reached double digits. Okay, we're talking wholesale, definitely, even consumer inflation. You don't think of this in the late 1790s. You think we're on the gold standard, silver standard, there's no inflation. Okay, we had double-digit inflation for 3 or 4 years between 1793 and 96, and we had a boom. We had a business boom, which I'm sure some of you in the room can guess what's going to happen to this boom in a little while. All right. And back in the days under the gold standard, I don't have time to discuss the Hume specie flow mechanism, but in the days of the international gold standard, if prices rose too quickly in your country, imports looked more attractive, they were cheaper. So the ultimate outcome would be, it's kind of a self-regulating mechanism. Gold and silver would start to flow out of the U.S., and when it did that, eventually the banks had to contract their credit. They had no choice because their reserves started to disappear. By late 1796, businesses began to fail en masse, and by the spring of 1797, we have the panic, and this is a big one, by the way, the Panic and Depression of 1797. I put a little note here because those mainstream economists who do address this panic, they like to blame the Bank of England for it. In February of 97, the Bank of England went off the gold standard in anticipation of going back to war with France and Napoleon. The problem is the businesses started failing in mass 2 or 3 months prior to the Bank of England, so I think that one's pretty much been disproven. The Bank of England made things worse for certain, but the downturn in the U.S. economy had started beforehand. I found these great charts, by the way, in a paper by, I can't pronounce it, Curot and Watts. He said, George Mason doesn't surprise me, but a Johns Hopkins professor actually wrote this paper and did this research. See, we can see here, and I'm looking predominantly at the red line, which is the Bank of the U.S.'s balance sheet. So their assets are going up because they're issuing credit, right? They're buying assets and they're issuing banknotes in return for those assets. You can see the line, this little blip here, that's the Panic of 1792, right, where they had to curtail credit briefly, except of course for the 2 bankers who were in trouble. When that was over, as you can see here, they didn't learn their lesson, right? I mean, immediately the asset purchases started going up again and continued to go up. They leveled off right around the Panic of 1797, even went down some. Okay, here we have the inflation rate. So the red line is wholesale, and the blue line is what the consumers experience. As you can see, it peaks around 1795 and 1796, and then we go into a deflation, which was what used to happen. What happened in those days, right? When you had a depression, the banks curtail credit, the money supply contracts, prices actually go down. Can you believe that wholesale inflation was over 50%? In 1795, even under a gold and silver standard. This is how much influence the Bank of the United States has. And then this is an index of industrial production, so we can see the boom here. And then here's the recession, or what they call the depression back in those days. So it peaks in 96, and then we have 2 years of depression. And then business resumed actually quite strongly, which was typical back in those days. That's before we had the Obama stimulus and cash for clunkers. In the old days, the depressions were over pretty quick, and the recoveries were violently strong. I actually found the data on this chart, and I did the math on the industrial index, and it looks like it's a 7.26% decline. So the closest analog I could find, does anyone remember the Volcker recession of 81, 82? That's where unemployment hit 11%. Yeah, I was a kid, but I remember my mom freaking out, worrying about her job back then, okay? So it was not quite as bad, which isn't saying much, as the Volcker recession. But the Volcker recession was, if anyone who remembers those days, it was very painful. There were, union workers were sending car parts to the Federal Reserve in protest or something. There were all kinds of funny protests going on because it was so bad. And the unemployment rate actually was higher in 1982 than it was at the peak of the Great Recession. It was 1 point higher. Okay, the Bank of the United States charter ran out in 1811 and was not renewed, which is probably one of the biggest cases of bad timing in the history of U.S. government finance, because 1 year later a war started, the War of 1812, and there was no central bank, which is what governments typically rely on when they want to fight wars. So as a substitute, the federal government approved of an indefinite suspension of convertibility to gold or silver. Now this actually started at the state level, but Congress approved it when they saw what was happening. They said, yeah, it has our blessing. So this was designed to create inflation and more credit. If you think about it, if the bank is absolved from any responsibility of redeeming the banknote or a deposit account into gold or silver, what's to stop it from just printing more banknotes and issuing more loans in the form of deposit balances? That was the intended effect, and that's exactly what happened. So banks began lending wildly, and this made the federal government happy because it needed the credit in order to finance the War of 1812. And not only was there more credit, but there were more banks. People started hopping very quickly into the bank business. As you can see in my second to the last bullet point, from 1811 to 1815, so that's in 4 years, the number of banks in the United States grows from 88 to 208. And 1 year later, it grows to 246. So that's what, a near tripling of the number of banks in 5 years. It's kind of like, guys remember the dot-coms when everyone got crazy about the dot-com business? Dot-coms just started popping up left and right, most of which ultimately failed. It's that same kind of mania. So when the war is over, Congress is worried about what happens when they resume convertibility, because the banks aren't going to have the gold or silver to back it up. So to smooth out the process, I think it was Madison, chartered the second Bank of the United States to manage this process, to suppress the issuance of private banknotes. Okay, so the idea is the Bank of the United States will hold these private banknotes and exchange them for their own, and then it will measure the rate at which it submits them to the state banks for redemption. Instead of offering them all at once, which would bankrupt the state banks, it says over a long period of time it will redeem them. The problem, this is great in theory but bad in practice, was at that time the second Bank of the United States was fairly corrupt. Okay, so we have, for example, in the Baltimore branch, a flat-out case of embezzlement by the directors. Okay? And instead of restraining the state banks, the second Bank of the United States operates as its own enterprise and proceeds to expand credit of its own banknotes even further. As you can see, by 1818, the second Bank of the United States has $23 million in deposits in banknotes, but their reserves of gold and silver are only $2.5 million. So that's a reserve ratio getting close to 90%, which is kind of unthinkable back in those days. I mean, today we take a 90% reserve ratio for granted in the age of fiat money, but back then, for the nation's central bank to do that was very, very risky. And by 1816, the United States is in its first nationwide speculative bubble. 2 years later, we're up to 392 banks. So I can't do the math, but what is that? Close to a quintupling of banks in 7 years. Land speculation goes wild in western states. By western, I mean like Kentucky and Ohio and Missouri. And Thomas Jefferson wrote a letter in 1816 to his friend. It says, our deluded citizens are have a number one in there, sorry. Our deluded citizens are clamoring for more banks and more banks. The American mind is now in that state of fever, which the world has so often seen in the history of other nations. We are under the bank bubble as England was under the South Sea bubble, France under the Mississippi bubble, and that's not a misspelling, that's how he spelled it back then. And as every nation is liable to be under whatever bubble design or delusion may puff up in moments when off their guard. So even Jefferson saw that this bubble was forming. So eventually, there's so many banknotes floating around that the public starts accepting them only at a discount. And then the beginning of the end occurred in 1819 when Washington, D.C. was scheduled to repay France for the Louisiana Purchase. And for the terms of the contract, well, we had to pay in gold or silver, no banknotes. And the United States, since their banker was the second Bank of the United States, that's where they went. Right? They said, we want to cash in, we need gold or silver to transfer to France to pay them back. Of course, when the Bank of the United States has to give up that much gold or silver, it begins a major contraction of its own credit. And that's what burst the bubble in 1819. We get our first really really, I mean, the 1797 depression was bad, but the 1819 depression was like the first major depression economists write about in our history. And I have some statistics I found. Unfortunately, it's just from Philadelphia. Manufacturing employees fell from 9,700 to 2,100 people from the peak to the trough. So that's 78% of manufacturing employees lost their jobs. Our exports fell from 93 to 70 million. That's down 25%. But even worse, and this is a better indicator of how bad the economy was, our imports fell from 122 million to 74 million. So that's a 39% drop in our imports. It's all the result of the depression. So again, if someone says, oh, it was because we didn't have a central bank in those days, you can now say, well, actually, in the panics of 1792, 1797, and 1819, we had panics precisely because of the central bank, not because we didn't have a central bank. Okay, I'm skipping Q&A for this section, and we'll have Q&A after the third of our four topics.